Hey, welcome back to the channel, Data Financially Follow. On this installment, I think it would be prudent for us to discuss why wealth building should be boring. Nothing exciting, nothing flashy. If your wealth building story is exciting and it's riveting and it gets the people going, it's probably risky. There's probably a fair amount of drama that's building up in that story. Because real wealth is sustainable, it's repeatable, you can sleep well at night, it's doing things that are honestly pretty boring. No adrenaline, no hot tips, no constant action. You're not gonna hear about this from your bookie or you're gonna hear it from your caddy. The problem with excitement is we get so caught up on the dopamine rush that comes from day trading or the newest crypto, or as recently as the short squeeze that came out. And these are one-offs. We all wanna post those screenshots of how I made $50,000 in a day. And great, I mean, none of that's inherently bad, but it just creates an underlying expectation. And that expectation is that this is a repeatable process. Wealth building is about managing risk and yielding return. If I am high in leverage, I'm speculating out the wazoo, and I'm letting my emotions guide me. This is not something that's repeatable. I cannot repeat with consistency. And it's that consistency that's going to win. Markets don't reward intensity. Like, I can get all into one stock and really believe in it, it's gonna bounce up. But things crash. That run on the banks not too long ago underneath the Biden administration, and people who were betting that it was gonna come back, like, oh, well, they bottom out in '08, they'll save the banks again this time. And for Silicon Valley Bank, First Republic Bank, these banks did not survive. And if you were catching that falling knife, I do feel sorry for you. But what actually builds wealth is spending less than what we make. So that means we can invest regularly on a consistent basis, staying invested through not just the lows, but also the highs. And knowing that we're gonna go through these market cycles, but by staying the course, that passive investment will always outperform active. That's gonna be our strategy. It's going to be, if we have to rebalance, we rebalance occasionally. It's not like I'm trying to rebalance daily or weekly or monthly. It's letting compounding interest do its work. It's nothing crazy, no secret sauce. You just gotta be boring with it. Patience, and it's boring. Wealth building, that's the key. Boring is predictable, and predictability wins because we have a higher savings rate. Our asset allocation is solid. We're looking at tax efficiency. We're doing risk management because we cannot control the markets. We cannot control the returns, and we cannot control the headlines. Elon Musk is one tweet away from making Tesla go up or going down at any given moment. But if I'm boring and I'm predictable and I stay the course, I just don't need to panic. And I just ride the wave because I have a plan in place. But people struggle with boring. And I get that because it's always about chasing that next high. I want to make sure that we're on the next win over here. But I'm just telling you, that's all fluff. You don't need the bragging rights. You don't need the screenshots. You don't need the stories at the parties. And when markets are volatile, I mean, that's a great time to get in. But it's also a time like, hey, we don't need to panic. And if I have a steady savings strategy in place, then when the markets go down, I am steadily going to be putting it back in there. And I'm not trying to time it either because my strategy says every month, 2,000, boom, boom, boom. 401k, here's every month, 2,000, boom, 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 boom. To this brokerage account or saving for my kids, whatever it may be. Put that saving strategy in place, and whether it's up or down, just follow it. Consistency, consistency, consistency. That consistency is going to protect you from you. Build out automatic contributions. The less you're able to run your own finances, it's actually kind of the better. Because if once you automate it, you don't have to think about it. It's the first of the month. I know I'm gonna have these bills. Here's that 2,000 automatically deducted. I can't spend it if I don't have it. And unfortunately for a lot of people, it's I had the money in my pocket at the end of the month. Well, you know what? It was a good month for me. I'm feeling great. We're gonna go out. We're going to enjoy it. So instead of investing it, I felt the need to spend it. Whereas if I set these rules and guidelines, it will go in and I don't have to worry about it because my budget says It goes in the first of the month. I have pre-planned when I want to rebalance. Now maybe I'm gonna look at it, once a quarter, maybe I look at it once a year, but I plan for it. And I set up guardrails to protect me during volatility. Being boring prevents over trading, chasing trends, panic selling, and overreacting to the noise, media, what you're hearing from your friends and family, and shifting our mindsets into wealth instead of entertainment. I think with Robinhood, they have gotten better, but still very much gamey mindset. When you place a trade and then confetti comes off and you're trying to light, it's creating that gaming mentality. Like, hey, even though when you sell or you bought it might have been a win or might not have been a win, but they still give you the same kind of animation. And it's supposed to, trigger the same thing why casinos have invested in those kind of gaming animatronics and animations as well, because they want you to feel like, hey, this is good, this is fun, let's keep this going. Set your systems, work with your financial advisor on getting something that works for you in your plan to make sure that you can meet your goals, whether it's saving for your kids' college education, down payment on a house, retirement, long-term care, lots of different fiscal goals out there for us to, work towards. And it's not about the entertainment, it's about quietly, reliably building towards it, managing risk while achieving those rewards. And when we think about people say, oh, just boo and chill, that's not wrong. Or, I want to go ahead and be invested in these other things. How well can you achieve the same thing as VU, but manage the risk better? Because if you can achieve that same comparable reward and lower your risk, that's better than I'm meeting this and I'm taking on more risk. Or I've taken on more risk just to achieve this, but I've still got a lot more risk. So understanding your risk tolerance really comes into play here too. Those quiet wins are still wins. So, in closing, if you're building wealth and it doesn't feel flashy, it feels slow, quiet, methodical, good. That probably means that you're working. Even if it doesn't feel like you're getting there fast enough, let the math do what the math is going to go do. And if you ever want to take the time and say, hey, maybe this is a good touch point to go get in touch with a financial advisor, I just need a sanity check. Am I on the right track? That's a great conversation to have. Don't need to go make the headlines. You just focus on what you can do and setting these things up for success for you. Boring builds freedom. Thank you for joining. Once again, this is not financial advice. This is financial education. And always talk to your financial advisor before implementing any overall strategy. And if you enjoyed this channel and you like the content, hit that smash button that you like this and subscribe, because I'm here to keep on providing. Thank you and have a great day.